All right, well, we are going to get started. Good morning. Thanks for joining us today. We have a full session today, so I'm going to try to keep this brief, the intro brief, so that our presenters can really Baystate Financial. Bill joined Baystate in 1999 with a mission to assist individuals, families, and business owners in defining their goals and achieving financial security. With 50 years of experience, Bill is highly trained and licensed to provide unique solutions to meet the needs of his clients. As a lifelong resource to his clients, Bill has always been dedicated in guiding clients through various stages of their financial lives. So Ryan and Bill are here today for an educational session with information on executive compensation and SERPs for credit union CEOs and executives, and how credit unions can use these benefits as they seek to attract and retain new talent to their executive ranks. As you all know, we are seeing the turnover and job jumping within our industry, especially since the onset of the pandemic. And so it's important that our credit unions have as many tools in the box to help them navigate this new landscape and figure out how to attract executive level employees, but then also retain them. That's really been the challenge that we've seen over the past couple of years. So MSIC felt that executive compensation and retirement plans are one of those necessary tools, and that's what brings us to this webinar today. Just a note, during the presentation, Ryan and Bill invite you to ask questions or comment. You can do that by hitting the raise your hand button, and I'm going to unmute you so you can jump right in. Or I know a lot of you prefer to just send the questions to the question and answer or the chat box, and I'm happy to read those on your behalf. We're also going to have a little bit of time at the end for Q&A, so feel free to save your question then too. And then one last note before I hand it over to Ryan and Bill. This is an educational presentation for the C-suite leadership of our credit union members. MSIC does not endorse any products or services, and we encourage our members to do their own due diligence about any compensation or retirement plans, as we know you would. And with that, Ryan and Bill, I hand that over to you.
Well, I was going to introduce us all, but Erica, you did a great job of summarizing not only who we are, but what we're going to be talking about. So Ryan's really going to drive the train. So I'm going to turn it over to Ryan right away and utilize our time as best we can. So Ryan, carry it away.
Thanks, Bill. Good morning, everyone. Very nice to spend some time with you this morning. As Erica mentioned, we're going to be going over some high-level ideas and concepts around retaining, rewarding, and recruiting top-level talent in the credit union industry today, trends we're seeing in the industry, as well as different types of vehicles that you as an institution can leverage when looking to invest in the human capital that's running the day-to-day operations of the institution. So what I'm going to do is share my screen, and this material will be shared with the entire group after the call if it hasn't already been shared. So feel free to take notes as you deem appropriate, but by no means feel like you have to memorize all the information that we go through. And as Erica mentioned as well, feel free to interrupt me with any questions as we go along. But to start, a key thing to discuss is what are supplemental executive retirement plans, or often referred to as SERPs. These programs are non-qualified benefits or deferred compensation, with the key word being non-qualified, which means unlike traditional core benefits, these programs do not need to be offered to every single employee at your credit union. You can discriminate who gets to partake in a plan, whether it's just the president, CEO, or it's multiple members of your C-suite or people that you find hard to replace or positions that are hard to replace. And then beyond deciding who gets to partake in a plan, each plan can be customized to the individual in question, which is very important because, again, if you're looking at locking in your C-suite and you have people in their 60s, their 50s, and their 40s, the retention goal from the institution's perspective may not be the same for every single individual on your team. Some people you may want to incentivize to stay 3, 4, 5 years and then reevaluate at that point. Other people you may know are the right fit for the long term, and you want to lock them in all the way out to a stated retirement date. What's great about these non-qual plans is you don't have to find one solution that fits everyone the exact same way. You can customize each plan to the individual in question. Now, just so you're aware of what's in this presentation, again, we're going to go a brief overview of what's going on in the industry, both from a national, federal level, as well as on a state level. From there, we'll go over 2 different types of supplemental executive retention plans or SERPs. Ones that you're probably more familiar with, which are retention-based SERPs, as well as some newer concepts more that are focused on retirement and ways for highly compensated individuals to defer more of their own income, tax preferred, to a later date. We'll then wrap up in regards to kind of expectations post-implementation. Again, one of the things we highly recommend all credit unions that implement and choose to leverage these types of programs is the importance of ongoing servicing and administration of these programs every single year. Again, these are not meant to be static solutions, things you put in place and forget about. They do need to be reviewed on an annual basis and often updated over time to ensure they're still aligning with both the institutions as well as the participants' goals and objectives moving forward. So some of this may be information you already know, but over the past 20 to 30 years, unfortunately, there are a lot less credit unions year by year. A lot of this is mergers, acquisitions, changes in the regulations that are causing more and more credit unions to basically come together, which is resulting in the need in the competition of top-level talent becoming even more fierce. In addition, we're seeing a lot of people turning over, one due to the baby boomer generation finally approaching and now starting to go into retirement, as well as some of the fallout still from the COVID-19 pandemic and a lot of burnout of executives that may have wanted to work a few more years, but now after the last 3 or 4 have decided to retire a little bit earlier than planned. So there are less and less credit unions. More and more people are turning over, a lot of young talent coming into the credit union industry. So what we're seeing is an increase in the prevalence of supplemental executive retention plans. And this is just a snapshot of the 2022 NAFQ and Gallagher Executive Benefit Survey. One thing you'll notice here is that the percentages typically go up the larger a credit union is, but the thing that you do not see on this screen is what this looked like 5, 10, 15 years ago. Almost all of the numbers in every single bucket were about half of what they are today if we just go back 10 years ago, and only approximately 10% of credit unions offered SERP plans back in 2009, 2010. So key thing here is that though some of these percentages, especially for smaller credit unions, is still on the lower side, these numbers have been only going in one direction, and that direction has been up each and every year. Often to the point that SERPs are not even things that you can leverage at this point to be creative or competitive or offer something that maybe another credit union isn't considering. It's becoming the norm where you almost have to offer a plan just because you know your peers are going to do it. And thus, if the board wants to lock in their CEO, or if the CEO wants to lock in their key members of their C-suite, they need to typically offer these programs once they know that someone is the right fit for the long term. Another thing you may see is also in most employment contracts or employment agreements when bringing in an executive from the outside. Often now, one of these programs is part of that benefits offering that you're offering the individual, again, assuming they're still at the institution 12 to 24 months after placement. So again, we're seeing a lot of people turning over. We're seeing an increase in supplemental executive retention plans. We're also seeing less and less credit unions and the need to compete for top-level talent increasing year by year. Now, in addition to that, the regulatory changes, the regulatory rules and guidance changes year by year. Some of the things you see on the screen are just some of the recent changes on a federal level. looking at split dollar, 457, the Tax Cuts and Jobs Act from 2017, the NCUA releasing additional guidance tied to otherwise impermissible investments. Going back to something I mentioned earlier, this is one of the main reasons the ongoing and servicing and administration of these programs is so vital, is that nothing is static, regulations change, and being aware of what's coming down the hopper or what's about to happen in the very short term is something that's obviously very important when ensuring that your plans are compliant, competitive, and doing what they're supposed to do for both parties. Split dollar specifically has not had any reg changes since 2002, 2003. There is nothing currently down the hopper showing any additional changes to those programs. But again, even though these regulations were viewed as the final changes, the IRS has often gone back to the well and made further changes historically. 457 just went through a recent reg change in 2015 through 2018. Again, I don't imagine any material changes within the short term, but if we fast forward 10, 15 years, there could be some additional changes to those programs as well. The 2017 excise tax from the Tax Cuts and Jobs Act, where they're now basically penalizing nonprofit institutions whenever paying any individual over the $1 million threshold, is something that for most credit unions is not a material issue. But again, depending on the types of programs that you're offering, the size of the institution, and if their benefits within these programs are received as lump sum taxable benefits, this might be something that now is in consideration for a program that you may have set up well prior to 2017, where this was a moot point. And then again, the examiners are getting more well-versed in these programs, which has its pros and cons. The pros is they understand what you have. They're going to be on you to make sure that you're administering the plans properly and that the plans are doing what they're supposed to do. But also that does mean that they're going to be much more honed in on certain limitations when it comes to putting dollars into what are considered otherwise impermissible investments. And otherwise impermissible investments is just a fancy way of saying life insurance, annuities, money in the market, everything in between that credit unions traditionally cannot put capital into unless they use it in one of three ways: charitable donation accounts, employee benefits pre-funding, and then for today's discussion, supplemental executive retention plans. The final piece is on a state level, again, tied to the same $1 million threshold. There is now a new surtax on any dollars received over the $1 million threshold, specifically a 4% surtax, and that is to the individual, whereas the 21% penalty is to the institution from the Tax Cuts and Jobs Act. But again, if you have, let's say, a 457F lump sum payment coming due, or if you have a relatively material 162 restricted bonus plan, either of which could put you over that $1 million threshold, not only is the institution paying additional taxes and costs, it could also now, starting today, impact you as an individual as well. So I'm going to pause there. I know that's a lot to digest all at once, but quick snapshot as to what we're seeing in the industry, some of the regs that are governing these plans on a federal as well as a state level. Are there any questions prior to us getting into the different plan types?
If anyone has any questions, you can raise your hand or send them in the text box. Nope, Ryan, it looks like you can continue on.
Perfect. So we have two different types of supplemental executive retirement plans we're going to be going over today. First, retention, and then retirement. One thing you'll notice as we go through this conversation is there is no perfect program. If there was a perfect program, I would make this simple. Just review one concept and say this is the best plan to do in all situations. Again, that's not the case. Every plan has its pros and cons and also has situations where it makes more sense to apply that plan versus another. So again, the initial education on these plans types is vital when considering either implementing these plans for the first time and or looking to revamp current programs. So again, looking at employer funded dollars, so something you want to do to help retain, reward, and recruit top level talent. There are three plan types: IRC 457F, IRC 7872, and IRC 162. The first one, which is IRC 457F, is by far the most simplistic of the three options. And I would also argue it's probably the second most popular currently in the credit union industry today. At a high level, the way a 457F plan works is there is a legal agreement signed day one between the credit union and the recipient in question. that's going to govern a benefit to be paid at a future payment date. Now, there are two ways you can design a 457F plan, either as defined contribution or as defined benefit. No right or wrong answer, it's more preference. Defined contribution could be viewed similar to like a 401k, where the organization is defining how much they're going to put into the plan each year for a period of years, or maybe they just put one upfront investment into the program, and then that's their sole contribution over the entirety of the plan itself. Now, in defined contribution plans, most commonly we'll then see those funds invested in the market, and usually the executive has some level of discretion, if not full discretion, as to how those funds are invested. Now, upon reaching the future benefit date, which is outlined within the legal agreement, shorter term 3 years, longer term out to a stated retirement date, either the growth on what's been put in or the growth plus the principal that was contributed is then payable to the individual at that future payment date. It is then viewed as ordinary income in that year, taxed, and then whatever's left over can be used however they deem most appropriate. So in other words, you can put in 15% of base compensation annually into an investment account. That investment account grows, and then either both the contributions plus earnings is payable at that future benefit date, or just the earnings if the institution wants to recoup its initial investment put into the program. On the defined benefit side, it's even more simplistic. You want to retain John Smith for 10 years. You decide to pay X dollars to that individual in the 10th year. What you do as an institution is you simply accrue that future liability in smaller increments. So 1/10 of X each year over the next 10 years. And then if the individual is still with the institution at that point in time, they fully vest in their benefit, again, receive it in a lump sum, pay taxes at that time, and then can use the net proceeds however they deem most appropriate. So relatively simple plan. There are no limitations outside of excessive comp rules in regards to how much money goes in or what benefit you're looking to target. Ideally, the benefit is competitive, so it's not viewed as excessive, but at the same time is not quote unquote nickel and diming the individual in question. So again, if they get calls from headhunters or recruiters, they're not going to get a better offer from a competing institution. Now, with more simple programs, there are inefficiencies. So from the organization's perspective, like traditional compensation, this is an expense to your bottom line. So again, assuming this plan goes to fruition and retains the individual in question out to whatever the agreed upon retention date is, this is a sunk cost. In addition, from the participant's perspective, this benefit is subject to institutional creditors until received. It also has what's called substantial risk of forfeiture laws, which is a very fancy way of saying the second you own part or all of your benefit, that is when taxes are due, not necessarily when you receive the funds. So all of these programs are typically set up with cliff vesting, which means 0% vesting each year out until the benefit date, and then fully vesting all at once. The final consideration from the individual's perspective is this is a fully taxable benefit that's very hard to move once the plan is put in place. So again, very restricted in regards to when and how they take the money, subject to creditors, no vesting, but assuming you vest and reach that access date, you do get the benefit all at once, pay taxes, and then can use the net proceeds however you deem most appropriate. So when would you potentially use a 457F plan? Most commonly, we see 457F plans used in one of three ways. Short-term retention. So you have someone you want to retain 3, 4, 5 years and then reevaluate at that point. Typically, the 457F plan is best utilized at that point in time. Vice versa, let's say you have someone very close to retirement where retention is not a concern, but you do want to reward them for past and remaining tenure and set the precedence that this is something you do for people in that position to help add quote unquote teeth to ongoing succession planning. Again, a 457F is a nice formal way to say thank you to an executive who's put in a lot of years to the institution and make it evidently clear to whoever fills those shoes that this is something you do for people who do a good job in that role. The third piece is in a situation where the individual is unhealthy and cannot qualify for life insurance. What you'll notice in the next two programs is both of them involve life insurance and both of them involve full medical underwriting. So even in a scenario where let's say you want to lock someone in 10 years or more long term, if they can't qualify for life insurance, making the other two options not available to them, this is a good fallback option given that life insurance does not need to be included in this program. So again, I know that's a lot to digest all at once. Definitely feel free to jump in if you have any questions. So a 457F is really good on short-term retention, short-term reward. On the other end of the spectrum, collateral assignment split dollar is more of your traditional golden handcuff, or something that you would do for long-term retention, long-term reward. Also, split dollar is now by far the most popular tool that's being used in the credit union industry. Probably 5 years ago, 457F was still the most popular, with split dollar gaining more popularity year by year. And then at that point, split dollar surpassed 457 and is by far the most commonly used program in today's credit union industry, especially among CEOs. Now, the way split dollar works is there's a legal agreement signed day one between the institution and individual in question that's going to govern how the plan works, similar to how the 457F is set up. However, in this program, the credit union is going to make a loan or a series of loans to the executive to cover the cost of a life insurance policy that the executive personally owns. So if any of you are familiar with credit union-owned life insurance or bank-owned life insurance, it's a very similar type of contract, with the key difference being that the participant is the owner, not the institution. For those who are unfamiliar with those types of programs, the type of life insurance we are purchasing in a split dollar plan is a form of permanent life insurance, whether whole life, index universal life, variable life, all of which have in common cash surrender value and death benefit that grow each year, typically at an average rate of return of about 6%. Now, you may ask, why go through the hassle of structuring this as a loan? Well, by leveraging a loan, the institution is actually going to make money on every dollar they put into this program versus spending money, which is the traditional way of providing comp and benefits. Or in other words, this loan is going to be a performing asset on your books, earning a stated rate of return each year moving forward to eventually get repaid both principal plus interest via the death proceeds when the insured passes away. So it looks a lot like a 30-year mortgage with a balloon note rate structure, in that you're getting the positive impact to your P&L from the accrued interest income each year. However, you do not get the money back or the positive cash flow until the death proceeds kick in and repay the institution first and foremost every dollar they lent out to the individual, plus all the interest they booked along the way. Now, in order for this plan to work, we do need to have some sort of delta between policy performance and the return to the institution. So for example, if the policy is earning 6 and the return to the institution is 6, then this is just a very unique way of structuring corporate-owned life insurance, because the entire policy return is being posted as collateral on the loan, leaving no benefit to the individual. Thus, a key thing to consider is, what is that rate to the institution? Now, in order for this loan to not be viewed as a below market rate note and thus not cause any level of taxation to the individual in question, the return on the loan must be set at least what's known as the long-term applicable federal rate, which the IRS resets every single month until you lock it in on the loan itself. So if the AFR is 4%, and that's the return we lock in on the loan to the institution, it's that delta of 2%, so 6% policy performance, 4% return on the loan. That difference of 2 is what's building the benefit to the individual. Now, assuming this is a retention plan, even though there is a delta day one, the individual typically does not have access to that money until they vest and reach the agreed upon access date. So one of the reasons split dollar is a more attractive long-term retention plan is, one, unlike the 457, this is not subject to institutions' creditors, but more importantly, they can have a vesting schedule with no tax consequence. So in the 457, if you're looking at a 10-year plan with cliff vesting, is that really going to retain someone knowing that if they only make it 8 years, they could be potentially leaving with nothing? Whereas in split dollar, you could vest them, for example, proportionally 10% a year each year for 10 years. So if they leave in the 8th year, no, they don't get 100% of the benefit, but in that case, they may get 80% of the benefit. So they've earned what they put in up until that point. Another very attractive thing about split dollar is upon vesting and reaching the agreed upon access date, the employee has full control in when and how the money is taken. They can take a lump sum, they can annuitize it. If they don't need the money, they can delay taking funds to get more in the future. And regardless of when and how they take the funds, everything is received tax-free. And most people prefer to not pay taxes unless they really love the government. So that's another reason why split dollar is so attractive in the credit union industry. Now, typically, this is where it seems almost too good to be true. You have a guaranteed performing asset on the books to the institution, no expense. Further, a protected, flexible tax-free benefit to the individual. Obviously, the IRS does not provide any sort of quote unquote free lunches. What are some of the trade-offs or considerations with split dollar? Well, one, on the surface, it's a more complex program comparative to the 457. The good news is the administration of split dollar is just as simple as a 457F. However, you want to make sure both the board, the CEO, any potential CERT participants understand how split dollar works, because why offer a program if the recipient or the people who are governing the plan don't fully grasp all the moving pieces? In addition, this is a long-term illiquid performing asset, which means any part of the plan, whether 1%, 20%, 100%, whatever portion is vested in by the individual prior to them leaving, that portion of the loan is going to stay on the books, earning interest until death. So again, it's a long-term illiquid performing asset on the books, and whatever stays on the books does count against the limitations in regards to what you can put towards otherwise impermissible investments, which is very important for smaller to mid-sized credit unions, because let's say it does do the job of retaining your current CEO, for example, they retire, that plan is still going to count against your net worth limits when it comes to how much you can put into these programs, which may limit the institution down the road for the next round of leadership or even the leadership team after that, if they're up against the caps and are looking to look for creative ways to retain their key people. And then the final consideration, again, this is life insurance. So you and or your spouse needs to be healthy enough to qualify for this program. Thus, if you're a single executive who had open heart surgery yesterday or just got over cancer, most likely you're not going to be able to partake in a split dollar plan. Again, a lot to digest all at once. Definitely feel free to jump in if you have questions or if you want to go over anything in greater detail. The final program from an employer-funded perspective is known as a REBA plan, or a restricted bonus arrangement, which is governed by IRC 1.61-22. If you draw a line down the middle of this screen, it looks a lot like a hybrid of the previous two programs. So from the participant's perspective, this looks identical to split dollar, but from the institution's perspective, it looks a lot more familiar or similar to a 457F plan. So the key difference between restricted bonus programs and split dollar is how the credit union classifies the dollars they put into the life insurance policy that the executive owns. As you may recall with split dollar, it is a loan to the executive where that loan accrues interest and gets repaid at death. In restricted bonus, instead of treating it as a loan, it's treated as an additional bonus to the employee. That bonus will cover both the premium as well as any new taxes that are caused from the inflation in income in that year. So there's no out-of-pocket expense to the participant during the funding years. And then when the individual leaves, whether let's say tomorrow, 5 years, 10 years at the retention date, the plan ends from the organization's perspective. Or in other words, this is a short-term expense-funded plan that ends the second the person leaves, versus split dollar, which is a long-term illiquid performing asset that gets repaid at death. So some of the positives of restricted bonus is it's a little bit more simplistic from a mechanics perspective. 2, given the institution does not own any of the life insurance policy or have any interest within the underlying life insurance policy, This program does not count against your net worth caps. And then again, this plan ends the second the person leaves, whether early or at the stated retention date. The downside of this program is, one, it is a cost. So like the 457F, assuming the plan goes to fruition, this is an expense to your bottom line with no cost recovery. And two, it will inflate the employee's income during the funding years. So even if we price it correctly to ensure no out-of-pocket expense to the individual, from an optics perspective, it will look like you're paying your individuals more than they're actually receiving while the plan is being funded. But if the option is 457 versus restricted bonus, again, most of our participants typically choose restricted bonus in that they have a plan that's protected from creditors, a vesting schedule, flexible benefit that they can take how they deem most appropriate when vesting and reaching the access date, and that, again, the money is received tax-free versus lump sum taxable. So when do you use restricted bonus? Well, if 457F is really good for short-term retention, let's say 3, 4, 5 years. Split dollars, more long-term retention, let's say 7 years plus. Restricted bonus, again, being a hybrid, fits kind of in between. Typically, we see it anywhere from 4 to 10 years as the range where most restricted bonus plans make sense. So again, 457, 3 to 5 years, restricted bonus 4 to 10, split dollar 7 years plus. That's not a hard science. It's just a rough guess as to what we typically see. But restricted bonus can be used kind of for both short, mid, and long-term retention. Split dollars more mid to long-term retention. 457 is more short to mid-term retention. So I'll pause there. Any questions on the retention-based SERPs before we go into the retirement-based programs?
It doesn't look like there's any questions, Ryan.
Perfect. So now we'll look at two other types of programs, specifically programs that usually we see credit unions utilize from a voluntary, no-cost, participant-funded perspective. One is more well-known, which is IRC 457B, and the other is known as participant-funded split dollar, which is a variation of the previous split dollar program we just went over. Now, again, though these programs can both be funded by the employer as well, more commonly we are seeing these programs funded by the individuals themselves as a way to defer more income, tax preferred to a later date. Now, the 457B, again, is the more popular tool. Really, these programs are basically a second 401k. However, unlike your 401k, this does not need to be offered to every single employee at the credit union. It could be a program just for your CEO or a program for the entire C-suite or whoever you define as highly compensated individuals who should partake in this additional benefit plan. The great thing about the 457B is it doubles how much money you can defer to a later date, and it's also not subject to the same highly compensated employee testing limits that your qualified plan may or may not be subject to. So for highly compensated individuals who are either maxing out their 401k or are unable to put the amount of money they want to put into the 401k due to highly compensated employee testing limits, here's another vehicle where they can put money away, either in the traditional format where it goes in pre-tax, gross tax deferred, and comes out taxable, or goes in after tax, gross tax deferred, and comes out tax-free if you use the Roth option. Now, what's great about this plan is outside of very, let's say, minute or low potentially implementation or ongoing administration costs, this really does not cost the institution much money to offer this program if they want to allow, again, some of their highly compensated employees to defer more income to a later date. Further, if the employer does want to put dollars into this program, they can do so on a discretionary basis where, again, they do not have to offer it to all employees. So for example, in your 401k, if the institution offers a match and or profit share, whatever they choose to do needs to be offered to everyone who's qualified to partake within that qualified plan. In a 457B, you can do a discretionary match or profit share to just one or multiple key employees without having to contribute it to every single employee's retirement account. Now, the 457B does have its pros and cons, just like every other program. From the employer's perspective, again, this looks like a 401k, basically a second qualified plan. So though the cost may be minimal, the ongoing administration of a 457B would be viewed at the same extent of your ongoing administration of your 401k. So we often recommend bundling this with your qualified plan provider to help make that administration less onerous to your HR team, as well as to ideally keep costs down. Could you have your 457B with a different vendor than your 401k? Of course, but again, that's just going to make it a lot more harder for the servicing of the plan. Again, looking at your HR team or whoever's responsible for handling these programs. In addition, the reason 457B is listed in the retirement section versus the retention section is even if the employer puts money in, typically they're required to vest those contributions in less than 3 years. So again, when you're thinking about having some sort of incentive out there to retain someone 3+ years all the way out to retirement, this is more of a competitive benefit to offer, not necessarily any sort of handcuff program. So you can view this as similar to providing a more competitive match or profit share in your 401k, better health insurance, better bonuses, higher base comp. It still helps from a retention standpoint, but there's no incentive or carrot that's being held out there that the person really needs to earn to partake in this plan. From the individual's perspective, some of the positives of this plan is one, every year they can pick and choose how much money they put in. So one year they can max it out. The next year they can put in 0. The following year they can do somewhere in between. They have full flexibility in when and how they put money in up into those limitations. And then further, they can have the funds invested however they deem most appropriate, similar to how they would within their qualified plan. The only downside of a 457B, or a few downsides from a 457B's perspective to the individual, is one, you are limited. So again, let's say you're making a decent amount of money and you want to defer 60, 70, 80,000 a year to retirement. You won't be able to do that amount within this plan, in that it only doubles what you can do within your qualified plan. So using round numbers, if the max you can put into a 401k is 20,000, this would allow you to defer another 20,000 for a max contribution or deferral of 40,000 in a given year, which for most people is more than enough. But for those who are really trying to ramp up their retirement savings, again, this does have a cap in regards to how much you can put away. In addition, like the 457F, any dollars you put into a 457B is subject to institution's creditors until taken out. The final thing with the 457B is it's very heavily limited in regards to what you can do with those funds that are put into the program, meaning the only type of plan you can roll a 457B into is another similar type 457B. You can't roll it over into an IRA or any other type of retirement account. And when you do leave the institution, the benefit is taxable to you at that point in time. So typically, most of the times when you reach your retirement date, you're going to be taking all of your money out at once. Alternatively, you can use participant-funded split dollar. It's the same concept as traditional split dollar, with the one caveat being that instead of just the employer loaning money for the purpose of retention, you are choosing to forego some of your compensation to then put into this program. More specifically, let's say you're making, I don't know, $300,000 a year. You want to defer $100,000 into this plan. You would sign a foregone compensation agreement with the institution saying that you want to take $100,000 less of income in that year. That $100,000 is then reclassified as a loan, is lent to you to cover the cost of a life insurance policy premium on the product that you own. And then you can take tax-free distributions down the road. So one of the advantages of this plan is, if structured correctly, the money goes in pre-tax, grows tax deferred within a life insurance policy, and comes out tax-free. So it's the only program in the world where you can avoid taxes at every point along the way. In addition, the only limitation in regards to how much money you put into a plan like this is the amount of money you're making. So again, if you're only making $300,000, you can't defer $500,000 because you're not making $500,000. Now, again, every program has its pros and cons. What are some of the negatives with participant funded split dollar? Well, one, again, it's life insurance. So you do need to qualify medically to partake in this plan. But also, with life insurance, there is a minimum number of premiums you need to make. And typically, those premiums, though there can be some flexibility in how much goes in year by year, it's not full flexibility like you would have within a traditional qualified plan or within the 457B. So usually we recommend 5 premiums for the plan to really work well. Most products can survive off of just 3 premiums, but typically somewhere between 3 to 5 contributions is going to be what's needed to make this plan work. In addition, if you want to put in that example, $100,000 a year, the lowest you could probably put in a given year is maybe $75,000. The most you can put in is $125,000. So unlike the 457B, where you can change how much you put in year by year, you would be committing to a relatively same amount of funds each year for a minimum of 3 to 5 years in order to avoid taxes at each part along the way. Now, again, the good thing about participant funded split dollar comparative to a 457B is the administration of the plan is a lot more simplistic. There is actually no cost. So it's not like adding a second qualified plan from the organization's perspective. And though obviously not the intent, because it is a loan, the institution still has cost recovery at death, meaning that instead of it being a sunk cost, it is money that you will get back as an institution at some point. Further, this benefit's not subject to institutional creditors. You have full flexibility in when and how you take the money, and everything is received tax-free. So again, this could be another way to allow some of your highly compensated employees to defer more of their income, tax deferred to a later date. And given the fact that there is that 3 to 5 year premium contribution minimum, in a way, it does create some level of retention, given that most people are going to want to stay for the 3 to 5 years in order to fund their life insurance policy with the pre-tax dollars. Or in other words, let's say you commit to a 5-year plan, you leave after 2 years, you own the life insurance policy, it's yours, it's money you've been putting into the plan itself. However, you may have to fund one more premium now with after-tax dollars, so more similar to a Roth IRA or a Roth 401k. So this program can create some level of retention in the fact that most people want to stay for the minimum funding years in order to make all of their contributions with pre-tax versus after-tax dollars. So those are the 2 most popular voluntary participant-funded programs. Outside of those 5, it's not in this presentation. There are incentive-based compensation plans, such as long-term incentive plans. Those are a little bit more granular. So if we have a follow-up webinar, I'm more than happy to take a deeper dive into those programs as well. But regardless of whether you do retention-based plans, retirement-based plans, incentive-based plans, or some sort of combination, again, I want to re-emphasize the importance of ongoing servicing and administration. For some of the newer executives on the phone who may now be dealing with plans that are still in the books from prior leadership teams, this is probably something you're already currently experiencing. But again, if the plans are not being serviced properly, it can lead to a lot of negatives, not only to the individual, but to the institution as well. And further, things change. So let's say this is the first time you're putting plans in place. You put in programs for your leadership team. Just think about where the credit union was 10 years ago. Then think about where it's going to be 5-10 years from now. Chances are the credit union is going to hopefully grow dramatically and change quite a bit. Further, the leadership team may change, the board may change, regs may change. So doing an overview of these programs year by year to ensure, again, 1, they're compliant, but also they're still accomplishing and maintaining the objectives, vision, and intent of both parties is really, really important. The good news is I would not expect you to have to make plan modifications as frequently as you may change base compensation or even bonus incentives. Typically, we'd recommend every 3 to 5 years rerunning whatever sort of analysis you did to come up with the competitive benefit, whether it's a shortfall analysis or some sort of peer data benchmarking analysis. And I would expect you to have to make some level of changes, whether material or non-material, typically every 5 to 10 years. So I'll give you an example. Let's say you have a CEO who's 45. The board would like to retain that CEO to age 65, a 20-year plan. Though by all means, you can set up a 20-year plan day 1. it's probably more meaningful and impactful to both parties to break that retention goal down into two tranches. So let's look at a 10-year plan to get this individual to 55. If we get that person to that point, let's do another 10-year plan at that point in time. If you do shoot for the 20 years all at once, there's nothing wrong with that, but do expect that you probably will have to make some level of changes, again, every 5 to 10 years. So in that example, maybe 1 to 2 changes in order to ensure that benefit stays competitive over that 20-year time frame. So that's all I have for today. Again, I wanted to make sure we left time at the end for any questions, comments, things people want to take a deeper dive into. So Eric, I don't know if you want to.
Yeah, Ryan, we actually did have a couple of questions come in. Let me just try to get them in the order. So the first one that came in said, could you speak generally to the disadvantages of a SERP for a credit union? Does the company receive an immediate tax deduction? And also, are those funds protected from claims in the case of insolvency?
Great questions. So
yeah, that was 3. So
yeah, I'll try to hit those in order. So let me know if I miss any of them.
Yep.
So some of the negatives of SERPs, I think they're only negative of a supplemental executive retirement plan if it's poorly placed or poorly understood. So what I mean by poorly placed is the plan was put in place for someone who probably should not be either receiving a plan or someone who's not really committed to the institution. So a great way to avoid that is making sure both parties are fully educated on what's being offered. So for example, let's say you're working with a vendor and the vendor is working with the board and the CEO. Chances are both the CEO and the board understand what's being put in place. And if they're both happy, then that would be a well-placed program. However, let's say the board and the CEO decide they want to offer this plan to 3 other members of the leadership team. And then these plans are just put in place, not with a lot of education and back and forth with those 3 individuals. If someone then leaves, let's say 2 days after the plan is put in place, that would be a time where a SERP is probably, one, poorly placed, but also now going to result in some sort of cost to unwind that program that was put in place and didn't retain someone right away. A way to avoid that is if you educate the individual in question as to this is what we're offering. We want to get some of your input on the plan. So maybe you leave a few of the variables within the contract open to interpretation or to get their input on. What you're really trying to do there is, one, are they actually paying attention? Is this something they're trying to learn more about? And are they excited about it? Or are they basically 1 foot out the door? And if the vendor's doing their job, they may be able to then relay that type of information to the board and to the CEO to say, this person really didn't pay attention. They weren't asking questions. They aren't replying to emails. Again, I don't want to read between the lines, but it doesn't seem like they're very committed to the institution or they're not excited about this program. Probably doesn't make sense to implement it. Again, they may not be leaving, it may be something else, but if they're not going to be asking questions, giving their input, seeming excited about the fact that they're getting this added benefit and getting reconfirmation that the institution really enjoys what they've done up to that point and want to lock them in long term, then probably does not make sense to implement a plan, at least at that point in time for that individual. I believe something in regards to tax write-off was the second question. So again, as a tax exempt institution, there are really no tax write-offs or benefits to you as an institution, given that you don't pay taxes to begin with. So again, when it comes to funding these plans, often the question is opportunity cost. So when you think about offering a program, what you're really comparing is not offering a plan and having the risk of losing that individual versus offering a plan and potentially mitigating that risk of losing the individual. So that's really, the institution typically knows better than we do as the partnering firm, which is, okay, your CEO leaves. How much time, effort, and cost is it going to take to replace that individual? You're then comparing that to, well, if we put this program in place and we're taking some of the members' dollars and using it as a way to invest in our human capital, is that a more cost-effective thing? And also, will that lead to a higher likelihood that we retain this person versus not? If the answer is yes, we do want to do a SERP plan, whether it's because we know it's the right thing to do or because all of our peers are doing it or because it's in their employment contract, whatever the reason may be, then you would do analysis of the 3 options we went over earlier, 457F versus split dollar versus restricted bonus, to see, one, which one buys the biggest benefit to the individual, which one looks more attractive to the institution from a financial impact standpoint, a net worth limitation standpoint, And again, that's what's so great about these plans is they can be fully customizable to the individual in question. So typically it's very clear as you start to identify each individual who may be a participant within a plan, which program is most effective, not only to the individual, but also to the institution's bottom line. And again, I apologize if I misunderstood that given the tax write-off piece, so definitely let me know if there was a different question within there. And then the third part is what happens in a liquidation of the institution. Well, that's going to come down to the program type. So in all three insurance options, split dollar, restricted bonus, and participant funded split dollar, the individual owns the policy. So in an instance of an institution going under, their products are not subject to institution's creditors, which means their benefit is fully protected, or at least their vested benefit is fully protected. And if within the legal agreement you define what a change of control is, which often includes the institution going under, the most common feature at that point is to accelerate vesting. So even if they're only 1% vested, they immediately become 100% vested, and thus their benefit is fully protected at that point in time. However, if it's a 457B or a 457F plan, where the asset itself is still owned by the individual until it's basically handed over at the retention or vesting date or at the retirement date, those benefits would be subject to institutional creditors. And thus, if the institution went under, again, there's a lot of quote unquote ifs within this scenario, more likely than not, that benefit will be lost.
Okay, I think, yeah, they said thank you. I think that there were a couple of questions regarding funding. I'll read the one that just came in, and then a little while ago, there was while you were speaking, there was another funding. So let's see if you can answer all of them. Is the funding of the employee-sponsored split dollar plan typically done all up front or with yearly contributions? And then to piggyback that, someone, Ryan, as you were speaking, had said, talk to me about the funding side and how the frequency of funding or how long the funding is versus short periods, a one lump sum versus payments over 5 years or payments over 10 years. How do credit unions decide to fund these plans, and what are the best practices around the speed of funding? So they all seem to kind of coincide. So I thought I'd give it to you all at once.
Yeah, great. So I'll answer that again in the order it was received. So when we're looking at the retirement-based SERPs, so whether it's 457B or employee-funded split dollar, if it's your own money you're choosing to forego, then they have to be funded either by your payroll monthly or annually. We can't typically pre-fund these plans. I mean, technically you could, but again, you've not earned those future years of income. So think of it like a 401k. You typically don't pre-fund a 401k. It's funded either as part of your payroll, or maybe the institution, to keep it a little bit more clean and simplistic, does one annual contribution over the course of a given year. So these are usually funded annually. Looking at the other programs, so on the employer funded side, each program is a little bit different. So a 457F by definition is unfunded, which means really it's just a legal agreement that's governing an expense to be paid out at a future payment date. However, a lot of credit unions typically fund otherwise impermissible investments, corporate-owned life insurance, annuities, money in the market to help cover the cost. And those investments, again, are owned by the institution, not the individual. If you had asked me this question 4 years ago, I would say almost every plan was pre-funded. But again, credit unions were in a very different position at that point in time. Rates were at basically all-time lows. A lot of credit unions were sitting on excess cash and deposits, especially post the COVID-19 pandemic. So that it was advantageous to the institution to pre-fund. In that one, there's usually a discount to the institution to put the money in all at once. But two, they had the liquidity, and often the returns on those types of products were far superior to where you could earn elsewhere, either lending out to your members or investing within the permissible 703(14) government-backed investments. However, in today's environment, often 457Fs and split dollars are typically funded annually, given the liquidity issues and fact that a lot of credit unions may even have to borrow to fund some of these programs if they're fully lent out. So the good news is, again, the 457, technically you don't have to put any money into an investment in the fact that it's unfunded. But if you want to invest in something to help cover your costs, pre-funding, the advantage is compounding interest. More money you put in quicker, the better the return is. typically the more cost effective the program is as a whole, but it would also work with annual funding if needed. Split dollar, typically the best practice here is to pre-fund, because one of the things you can do is you can lock in the long-term AFR on all future premiums. And the reason that's important is we know where interest rates are today. We know what the long-term AFR is today. We actually already know what the long-term AFR is going to be next month. If you annually fund a split dollar plan, which is allowed, I don't know what the AFR is going to be in December, let alone this time next year, let alone 3, 4, 5 years from now. So when we're dealing with the fact that the AFR changes, that's just another variable that we're putting into the program. And if you think rates are going to continue to go up, again, that's going to eat away at the delta between policy performance, what's going to the credit union, and what's left over to the individual. So what a lot of credit unions are doing today in split dollar is they're earmarking the funds. So they're still pre-funding to lock in today's AFR. However, they're not sending all the money to the insurance company day one. They're simply earmarking the account on their balance sheet saying, this is the funds we're going to use in the future to fund future premiums. So they can basically, again, control the AFR. However, they're then from a cash flow perspective funding annually, given the fact that they do not have the liquidity to fund this all up front. If they do have the liquidity, the advantage is, again, you get a discount. So instead of it being $1 million over, let's say, a 5, 7, 10-year period, you may only have to put in $925,000 if you send it to the insurance company day one. But again, that's assuming you have the liquidity to do so. Typically, I don't recommend doing that if you have to borrow funds from the Federal Home Loan Bank or somewhere else at a higher cost, again, increasing the opportunity cost on this program. And the final one, restricted bonus, this one is always annually funded. And the great thing about restricted bonus is you can fund it as quickly as 4 years, or you can spread out the premiums between now and the retention date, which again could be 10, 15, 20 years. So restricted bonus, you can fund it as fast as 4 years or as long as the retention goal. The reason you can't do faster than 4 years is because you'll basically create the life insurance policy to become a modified endowment contract, which is a very fancy way of saying that the IRS now views this as an investment, not as life insurance, and thus the benefit is taxable. The advantage of funding this program over 4 years or a split dollar plan over 4 or 5 years versus over 10 years is just like any sort of investment, compounding interest. The faster the money goes into the account, the bigger the compounding interest effect is, the larger the benefit to the individual. But again, something's better than nothing. So if you can only do it over 10 years, then that's better than not doing a program at all.
So they wrote, thank you. You've answered all my questions. And then there was one last question, which seems very relevant based on the industry now. It says, our new CEO is very close to retirement. Is it too late to put in a plan? Are there executive post-retirement options?
Great question. So again, it depends as to what the goal is. So if it's an executive close to retirement and they want to reward that person for past or remaining tenure and set the precedence that this is something you do for people in that position, because it's going to help them with future succession planning when they say to an internal or external recruit that we're going to offer you a SERP. And as you can see, we even did it for someone who's really close to retirement. The answer is yes, you can do something. Of course, your options are going to be a little bit more limited, or it may look less attractive just given time value of money. The less years we have to have something grow, the less attractive it may be, or the more money you may need to put in to make it happen. Some things you can consider is, one, if the individual doesn't need the money right away, it's more effective for both parties. So I'll give you an example. You have someone who's 63, wants to retire at 65. Yes, there's only 2 years between now and them retiring, but if they're willing to, let's say, delay taking the money till 68 or 70, so they still retire at 65, but they strategically spend down some of their other savings until the benefit kicks in, it gives the SERP program more time to grow, which makes it more effective and beneficial to both parties involved. If that doesn't work, there are other types of benefits. Again, we've been really focused on supplementing income, supplementing retirement. Technically, you can supplement anything. So you can supplement long-term care insurance, life insurance, disability insurance, medical insurance in retirement. So we do see a lot of those programs go into place. for especially people closer to retirement. And often that might be a more cost-effective way to deliver something meaningful versus trying to fund their retirement or supplement their retirement.
All right. Are there any more questions? Those were great. Thanks for, as always, participating. Is there anything else anyone has? No, just a lot of thank yous, and this was a really great presentation. I agree. Ryan and Bill, thanks so much for being here. We're so appreciative of your time. And then, as we had discussed before, this is a very helpful topic, very relevant right now. So we really appreciate this. It was a really good detailed look at SERPs and why they're important. To all attendees, today's webinar was recorded. I'll let you know when that recording is available. And if you are interested in getting a copy of the presentation deck, which I know a few of you have reached out, just give me an email and I will be happy to send that to you. And as far as our schedule, keep an eye out for information for next month's webinar before we take a break for the holiday season. And as always, share these sessions with your management and your executive staff. And thank you for being here with us today. And again, Ryan and Bill, thank you so much for your time. It was a really, very detailed presentation, and we're really appreciative of it.
Thank you, everyone.
Yeah, thank you. Take care. Have a great day.
Bye.